welcome to this very special conversation with arguably one of the biggest India investors and the most keenly heard voice on Indian markets, Adrian Lim from Aberdeen Asset Management.
Yeah, he joins us in moments from now, and I think all eyes out on what his thoughts are on the current market mood, the scenario, and his thoughts on the various aspects with regards to the Indian economy as well. But before we go to Adrian Lim, I think let's go to Darshan from our research desk, who has the highlights and the snapshot of the latest note that has come out from the Aberdeen stable. Darshan.
It is extremely important to hear the view of Aberdeen Asset Management because they are one of the largest investors as far as India is concerned. So their view does matter. What their view of firstly on the RBI governor is the fact that, they believe that Raghuram Rajan will be missed, but he is not replaceable because what the logic that they have said is the fact that, as much as what the RBI has done, it's the central government also that has done enough to get in a lot of money inflow. So that is what they're saying. The money that is coming in, the FDI that is coming in, the government also has a big role to play in this matter. Now, as far as who the next RBI governor is, a lot of 5 to 7 names are there, but according to Aberdeen, these two are the leading contenders. First of all, it's Arvind Subramaniam, or secondly, Urjit Patel, who most believe is the leading contender as far as the RBI governor is concerned. Now, what they talk about reforms, first of all, they believe that, change is taking place, but only it is more incremental currently. As far as the states are concerned, they're doing a lot as far as getting property is concerned, getting land is concerned for these infrastructure projects. So they are bullish on that. And the third point that they make is the fact that this government has been very notable in getting the projects off the ground, which has not been the case with the earlier government. So projects are taking place. There are a lot of green shoots that is there, what they are saying. Now, as far as tax laws are concerned, they are saying they expect a renegotiation. Obviously, they are impacted because they are a large FII who has a lot of holding in India, but they say according to them there will be renegotiations that will come in and they won't be affected in a severe way. And finally, as far as the economic growth is concerned, they are saying as far as on the paper is concerned, India is currently the fastest growing economy. What they are saying is, but India is not immune to global risk. So if there's something that will happen abroad or overseas, India will definitely be impacted because of the global issue that is there. As far as earning is concerned, they are saying earnings recovery is very disappointing. It has not come in. You've seen how Infosys and TCS, the largest two companies, have disappointed as far as earnings is concerned. And they are saying that investments in the short term will be led by public sector spending that will come in. So it's an extremely comprehensive and important view that Aberdeen Asset Management has given.
Let's bring on board a man who the market listens to, none other than Adrian Lim from Aberdeen Asset Management with big India holdings. So clearly, let's go across to him and find out how he's mapping India and the globe at this current uncertain times. Adrian, good morning. Thanks so much for joining in today on the show.
Good morning. Thanks for having us.
Okay, great. Adrian, I can't help but talk about the global scenario right now. Well, the markets have completely braved the Brexit event. We've seen a post-Brexit rally, so to speak, across the globe. But what, to your mind, could garner uncertainty again into global equities?
Well, I think the sentiment is extremely volatile at this point. We saw that if you looked at the immediate 5 days following the Brexit announcement and the flows that came off of that, I think the tone generally across the globe is still of one of anxiety, but there is a willingness to look for areas of relative shelter, relative resilience, and that has been to the benefit of the certain equity markets. Especially here in Asia, we've seen some resilience, and as a result of that, over the short term, we've seen some resilience, and as a result of that, people are looking at relatively safe harbors to put some capital at this point in time. But make no mistake, it's still a relatively anxious investing environment globally, and that money that has come in could easily flow out as well. So we are cautious and we continue to focus on fundamentals. The global flows are important, but we do need to be very disciplined and very focused on what companies and specific businesses are telling us.
Adrian, good morning. So, in India as well, it's looking completely like a liquidity-driven rally. My question to you is, for how long do you think this foreign flows can sustain into relatively safe harbors like India? Because that is the only thing that is holding the markets up right now. Do you think that comes in steadily over the next few weeks, or that's difficult to answer right now?
I'm sorry, but I can offer little assurance. I can say that the fundamental story in Asia has been attractive for quite some time. High savings rates still, relatively strong balance sheets at different levels, at the government level, at the state level, at country, household, individual levels. Gearing levels are okay broadly across the region, and demographics that lend themselves to good growth prospects over the next 2 to 3 generations. And in specific markets, a commitment to reform that's given them an extra boost. But like you say, it is a liquidity-driven rally. Over the last 5 years, we have gone out and we have spoken about these fundamentals. Sometimes people listen and people agree, and you see decent levels of flows. And sometimes it doesn't matter what you say. Sentiment continues to be quite raw, quite transient, and this liquidity could end at any time. That wouldn't surprise me.
So, Adrian, clearly you're saying that there is very well a chance that one could get back to Brexit day levels and the markets could completely give up this post-Brexit rally, because, you know, like you rightly mentioned, the fear is very much evident out there given the way bond yields are moving, given the way dollar has been panning out, and more importantly, you know, a rush to safe haven assets like gold.
Yeah, I would agree with that. You know, we can enjoy it while we can, but I would continue to focus most of assets, we as a house look at fundamentals and the strength of that over the long term. But people should make sure that their positions are fundamentally based. And to take a liquidity-driven call one way or the other is very risky.
Adrian, what about India? Not just the immediate term, but the medium term. I mean, are we a house of cards, or are we looking much more stable because of? We've just weathered the Brexit storm, if you will, very, very well. The markets have not really reacted too much to Governor Rajan's announcement. Monsoon has been good, and earnings, though patchy, look like on the mend.
I think there are quite a few things that are going for the Indian market. I think if you look at the macro situation, India's in a far better footing now than it was 2-3 years ago. There's greater clarity of targets, whether that's fiscal or monetary targets, inflation targets. There's been a greater commitment and drive towards meeting these targets. And there can be some slippages, but the scorecard is moving in the right direction. So we've seen inflation stabilize. We've seen the interest rates come to a comfortable level of rest. I think the bits that are challenging for India remains that the underlying levels of growth remain, like you say, quite patchy, and earnings are quite patchy. If you have a 5-10 year view, I wouldn't be too concerned. I think that the fundamentals within India are strong. I think the need for reform and the increasing recognition that the country needs reform is there. And I think that the RBI has built a solid foundation on which the next chief can build on. So I'm hopeful. But there's some periods of there's some issues of uncertainty, and but if you have a long-term view, I'm comfortable with what we see in India. There are some sectors that are fundamentally quite strong. I think the software sector is one that has a lot of strength in some of the key names. I think in the banking space, although there are some stress points within the sector, but you can also find good financial institutions that are well run and prudent. And I'll be careful about where we put money, but I think the country as a whole is on some promising footing.
I'm surprised you say that about IT, Adrian, considering the disaster that Infi posted this quarter and the guidance cut. It seems like IT growth per se seems to be in a bit of a quicksand scenario, if I can use that phrase. Would that make you change your holding in Infosys or a TCS? Or considering you're a long-term investor, these minute blips don't matter?
I presume that disaster, you mean the share price weakness?
Right, and also the guidance cut and as to how they're going to match up the industry average eventually.
Yeah, I think that the quarter's numbers have been disappointing. But if you look at the fundamentals of what these companies are, there is some volatility. What Infosys tries to do is it tries to deliver decent guidance, and that's just what guidance is. There is a tendency in this day and age to over extrapolate what these missed guidances are. I remember just within the last 2 years, whenever Infosys had better than expected guidance, they could do no wrong. And then 2-3 years before that, they can't seem to do any right, and then now they seem to have a disaster. So I think outside views tends to exaggerate the fortunes of the companies, especially in the IT space, where they're under a lot of scrutiny, and they have been actually pretty good about their long-term trends. I think if we were to apply the same levels of scrutiny to the other sectors, we would get far wider divergences of missed numbers. So I'm not too concerned about what we see in Infosys so far. Would
you look to adding more in the current dips that the market is giving us, though, when it comes to IT? Yeah, we would look to do that. We have quite a bit within IT, and the Infosys and TCS are the two of the bigger names within our IT space. So in weakness, we would add.
The area that interests me, Adrian, as I look at your top holdings as of June 2016 or a sectoral allocation as well, you seem to be, compared to the market benchmark, slightly underweight financials, 20% of your overall weightage. And if I look at your top 10, only one pure play bank, yes, HDFC is your top holding, but only one top pure play bank in ICICI Bank. Why is that?
Well, within the sector, we don't follow what the benchmark. We pay attention to what the benchmark components are, but that doesn't drive our stock picking decision at all. We do have HDFC Bank. We do have ICICI Bank. We have HDFC as well, and we have Kotak Mahindra. And our exposure is very much fine-tuning these four key components in our Indian funds. There may be some peripheral positions in some of the smaller funds, but that's the core of what we hold within finance. If you look at the benchmark as well, there are greater weightings in some of the other financial institutions, but these are the ones that we think will give us a decent balance of risk and return over the medium term.
So Adrian, clearly you're not going for the public sector banks, which a lot of people believe have a big bang for the buck here on, in a big way. Or even the NBFC story. Yes, there is HDFC, but there are so many other non-banking financial companies which everybody says are the real growth pillars over the next 5-6 years. You don't have a large exposure out there.
No, we don't. India gives us a lot of choice. We can pick a lot of things, and although some of your colleagues have highlighted the fact that at different times that we don't hold one stock or the other, we have a very concentrated approach to investing. So our Indian funds typically do not have more than 35 names at any point in time. But you shouldn't read into the fact that if we don't hold something, if it's not for us, doesn't mean it's not for somebody else. So there are interesting growth prospects in the Indian markets. There is some reform risk. There is some capitalization risk and you do see some non-performing loan cracks within the system as well. And so we have decided to be very selective about what we hold, and these are the 4 or 5 broad names that we have confidence in. But there are a lot of things out there, you're right, and we don't necessarily take exposure to those. It doesn't mean it's a bad thing. There'll be money to be made for other investors.
Adrian, it's interesting to see your large exposure in FMCG, be it ITC, Unilever, or for that matter, Godrej Consumer, when there is such a big threat from one of the indigenous, more organic brands, not listed, but that's posing to be a big threat for some of these FMCG players.
Which one are you talking about?
Patanjali, I'm not sure if you've heard of it.
Yeah, yes, there's always... They've been grabbing quite a few of the headlines, and it's been interesting, the products that they offer. But even before that private company came to play or became large enough, Indian FMCG is one of the most competitive in the world. If you look at the levels of packaging, the levels of sophistication in marketing, the levels that they manage their distribution network at, one player does not make the market more competitive. Even before this, the likes of Imami, Godrej, Jyoti have been competing very hard. And it's not just the locals as well. You have multinationals that have very big market share within the market as well. So we do like what we see when we talk to our companies. We do like the way they position themselves within the sectors that they compete in. And although it's interesting news flow to read about the rise of another entrant, it's not new news. It's a very competitive market. And ultimately, it serves the consumers better. It gives consumers more choice. And as a sector as a whole, that increases the sophistication of players within the market. And bear in mind, quite a few of the things that we hold have decent market shares in overseas markets as well. So anything that gets them better and more competitive will also translate to the amount of value and quality that they give to their overseas customers as well. And that's not a bad thing at all.
Right. Adrian, your notes that have come out recently speak about your thoughts, and correct me if I'm wrong here, that investment in the short term will be driven by public sector spending in India. Are you seeing evidence of that, one? And two, how will you play it via the stock market route?
How will we play what? Excuse me?
Public sector spending. I'm asking you because I think your thought is that investment in the short term will be driven by public sector spending. If so, are you seeing evidence of public sector spending? And how do you play that in the stock markets?
Yeah, we do see some evidence of that. Some of the statistics that have come out. Actually, what it reflects is not so much the strength of the public sector spending as the softness for capital expenditure in the private sector at this current point in time. In quite a few of sectors, utilization levels are relatively low. And you do see that the private companies are being very careful about how they spend money. They are using this time where demand is relatively soft across quite a few sectors to strengthen their balance sheet, to pay down their debts, to consolidate their financial position. And that's not a bad thing. But there is still spending power within the private sector. But until you get a stronger foundation for demand, whether that's a recovery over the next 2-3 monsoon seasons, monsoon periods, or a general strength of demand that comes through consumption, the private sector will be quite cautious. And that's not a bad thing. But it does mean that, what you say, in the short term, public sector spending will be more important.
What within healthcare interests you, Adrian? Because, one has seen the healthcare space be a little marred by US FDA slapping notices, etc., though there has been a change of heart and stance really off late. But what is your positioning within healthcare right now? Are you a little worried about the US FDA inspections?
Oh, yeah. Well, the US FDA inspections are important. They control the strength and the quality of the product offerings that the pharma companies deliver. And that's not a bad thing. We do know that the FDA resources in India is one of the highest in the world outside North America, and that's not a bad thing. That means that the standards that Indian pharma are being asked to deliver to are high. And what you do get is that once you do get periodically these warning letters or these consultation letters that come out, and that's why it's very important to make sure that the pharmaceutical businesses that you invest in are serious about their commitment to upgrade the quality of what they do, to upgrade and strengthen the processes and checks that they have. And we are pretty selective about what we do hold. We have some multinationals, we have Sanofi, we have Glaxo that feed their global pipeline into the Indian market, but we have some local pharmaceuticals as well. So we have some exposure to Lupin and Sun Pharma, and these are companies that over the long term have delivered good value in the pharma sector, but also are serious about their commitments to make sure that they are fully US FDA compliant, and that's very important to the long-term prospects of the company.
Okay. Adrian, as we wind down this interaction, how important is the passage of GST in the current session? If it doesn't happen, will it be a big disappointment for you as an investor?
Well, ultimately, we pick stock and we buy. We are exposed into the Indian market because we have faith in businesses and the people that run these businesses. We don't take a position because we price in the expectations and the delivery of GST. But GST it signifies two things. It signifies the country's willingness to make the tax structure and capture process more efficient, more effective. And it also signifies an opportunity for businesses to take advantage of an infrastructure reform that is beneficial to them and to their consumer base as well. And that's something that if it happens, and we've been talking about this for far too long, if it happens, we'll give the markets, we'll give investors, we'll give consumers, we'll give the people very good benefits. But it's something that the country needs to decide. India is a very vibrant democracy. There are lots of stakeholders that stand to benefit from the overall implementation of these policies, and we are hopeful that they will come to the table and agree. But in the short term, it doesn't affect our position, our commitment to the Indian market, but it would be a nice thing to have roll out.
Sure, it would be. Hopefully the passage and the rollout by April 1st, 2017. Let's see if that happens or no. But Adrian Lim, thanks so much for taking the time out and joining us today and giving us your thoughts on the markets.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.